The market sent a quieter message today, but quiet doesn't mean unimportant. Grain prices eased a bit, livestock strengthened, and the bigger story is how producers and agribusinesses are adjusting plans, budgets, and risk as agriculture starts setting the table for 2026. Good morning and welcome to Boots and Bushels, your daily look at the markets that feed America. As we start today, thanks for spending part of your morning with me. Let's begin where the market's settled, then we'll talk about weather, and we'll spend some extra time on the news and the forces shaping what comes next. Corn futures closed a little lower. March corn settled at $4.40.5, down nearly 2 cents on the day. Corn continues to trade like a market that isn't tight, but also isn't confident. The board is comfortable backing off slightly without fresh demand, but it's still holding together inside a range. Ethanol demand remains steady, exports are serviceable, and the market is waiting on something new to change direction. Soybeans also finished lower. January soybeans settled at $10.46.25, down just over 3 cents. Beans remain a market that reacts quickly to headlines and then fades again. Global competition remains stiff and end users are selective. Until demand shows urgency, soybeans are likely to stay range-bound. Soy products were mixed. January soybean meal settled at $296.70, down $2.10. January soybean oil settled at $48.93, up 15 points. That split between meal and oil continues to signal uneven demand across complex. Something worth watching as we move deeper into winter. Wheat closed lower. March Chicago wheat settled at $5.1075, down a little more than 2 cents. Wheat continues to deal with heavy global supplies and aggressive export competition. Even so, the market is still working to hold a floor rather than unravel. Cotton also finished mixed. March cotton settled at $64.01, holding steady despite ongoing demand concerns. Overall, grain markets today weren't panicked, just cautious. Livestock was the brighter spot on the board. February live cattle settled at $230.47, up $1.50. January feeder cattle settled at $349.55, up $2.55. Tight supplies continue to support cattle prices, even as the market keeps testing demand and margins. Strength in feeders suggest confidence further down the road, even with feed costs still a part of the conversation. In hogs, February lean hogs settled at $85.45, up 97 cents. In dairy, January Class 3 milk settled at $15.41 per hundredweight. Milk remains sensitive to demand shifts and production levels, and nearby contracts continue to carry more weight than longer-dated guesses. Weather isn't the headline driver today, but it remains the backdrop. Cold conditions across the Midwest are limiting field activity and keeping storage management front and center. The plains continue to see temperature swings that matter for winter wheat dormancy. The Delta remains more variable, with moisture and mild stretches supporting winter work, but keeping conditions uneven. Out west, storm timing and precipitation remain key concerns for specialty crops and logistics. As winter planning ramps up, one of the biggest shifts happening across agriculture right now is how early decisions are being made. Instead of waiting until late winter or early spring, many producers are pulling planning conversations forward, not because markets are strong, but because uncertainty remains high. One area drawing attention is input timing versus flexibility. Fertilizer, seed, and chemical decisions are being evaluated not just on price, but on delivery timing, storage risk, and cash flow impact. Some operations are choosing to lock in portions early, while others are deliberately staying flexible, even if it costs a little more, to avoid overcommitting capital too soon. Another issue gaining traction is labor and operational efficiency. With workforce challenges lingering in many rural areas, farms are evaluating how equipment utilization, custom work, and seasonal labor decisions affect both cost and reliability. These choices don't show up on futures screens, but they influence how aggressively operations are willing to market grain or expand livestock numbers. There's also growing discussion around regional competitiveness. Differences in basis, freight availability, and local demand are widening the gap between regions. When futures markets stay range-bound, local conditions matter more, and producers are paying closer attention to where their advantages or disadvantages really are. On the livestock side, planning conversations are increasingly focused on timing risk, not just price risk. Placement decisions, feed procurement, and marketing windows are being lined up with more caution as operators look to protect margins rather than stretch for top-end prices. What ties all this together is a quieter but very real shift toward measured decision-making. Instead of reacting to every headline, more operations are prioritizing consistency, liquidity, and optionality, even if that means leaving some upside on the table. The takeaway is this: even on a calm market day, a lot of meaningful decisions are being made, and those choices are shaping how agriculture heads into 2026 long before planting season arrives. To sum it up, grains eased a bit, livestock showed strength, and the bigger movement in agriculture continues to happen beneath the surface, in planning, timing, logistics, and discipline. Thanks for joining Boots and Bushels, your daily look at the markets that feed America. Keep your boots muddy and your bins full, and I'll be back here again tomorrow morning.